Today we will be comparing Coca-Cola Company and PepsiCo. I'm Cameron, here with Zara, Samuel, and Aroo. 131 years ago, Coca-Cola was invented. On May 8, 1886, Coca-Cola was created by John S. Pemberton and served at Jacob's Pharmacy. The drink's use was intended for medicinal purposes, but is today enjoyed as the world's most popular carbonated soft drink. The mission at Coca-Cola is exactly stated on their website as to refresh the world, to inspire moments of optimism and happiness, and to create value and make a difference. They have a 2020 vision into the future that serves as their framework that guides every aspect of the business towards growth. Coca-Cola is devoted to creating value for their share owners over the long term. Competition. Coca-Cola's major competitors are PepsiCo, Nestle, and Dr. Pepper Snapple Group. There are thousands of people that own Coca-Cola, so there is no one owner in the industry. The Coca-Cola Company is a public company that trades its shares on the New York Stock Exchange. The first shares of Coke were issued in 1919 with an initial public offering of $40. Today, you can buy a share for around the same price with its current price of $42.42. Coca-Cola is traded on the New York Stock Exchange, as I said before. The equity decreased from 2016 to 2017, meaning the number of shares increased. The debt of Coca-Cola increased as well, because the amount of money Coca-Cola borrowed increased from 2016 to 2017. As well, the equity decreased because the value of a stock of Coca-Cola decreased, so less chose to invest, so Coca-Cola had to borrow more from banks, which increased their debt. There are different institutional investors, for example, mutual fund companies and hedge fund companies. The company is in more debt because their assets decreased. Therefore, investors are less willing to buy shares in the company.
And now for a little introduction about PepsiCo. PepsiCo's mission is to be the world's premier consumer products company focused on convenient foods and beverages. PepsiCo has to compete with companies such as Coca-Cola, Dr. Pepper Snapple Group, and Kellogg Company. These companies compete to serve those in need of convenient foods and beverages such as potato chips and soft drinks. PepsiCo was formed when what was Pepsi-Cola Company merged with Frito-Lay in 1965. Since the merger, the company has further expanded by acquiring Tropicana Products, Quaker Oats Company, and Gatorade. A majority of PepsiCo's revenue no longer derives from the sales of carbonated soft drinks. The sales from Frito-Lay, Quaker Oats, Tropicana, and Gatorade have allowed PepsiCo to become the world's premier consumer products company focused on convenient foods and beverages. PepsiCo is publicly traded on NASDAQ. The equity decreased from 2016 to 2017 because the value of the stock decreased, which also leads to less investing by others in the future. Because the equity decreased from 2016 to 2017, the assets also decreased. PepsiCo therefore has to borrow the money from banks, which increases their debt to fund their operations. There are different institutional investors, for example, mutual fund companies and hedge fund companies.
The next 3 slides show the financial statements for Coca-Cola, which are made up of the income statement, balance sheet, and statement of cash flows. From the year 2016 to 2017, there were some major changes that had occurred in Coca-Cola. In Coca-Cola, some of the major changes that had occurred were in revenue, income tax, net income, liabilities, net tangible assets, and investments. Coca-Cola's total revenue from 2016 to 2017 decreased by $6.5 billion. This could have been due to the impact from foreign currency, showing that when foreign currency was converted back to American dollars, the American dollars ended up being less than what it was worth in foreign currency. The net income during these years also decreased by $5.3 billion, meaning that the company's revenue went down, as was mentioned above, and depreciation also went down, while interest and tax significantly increased. Another major change that occurred during these 2 years of 2016 and 2017 was that the total liabilities of Coca-Cola increased by $6.6 billion because Coca-Cola refranchised their bottles, which did not sell well and were not generating enough income to compare to the income that was put in. The stockholders' equity for Coca-Cola also changed a large amount to where it decreased by about $6 billion, along with retained earnings decreasing by $5 billion. Lastly, the investments from investing activities in cash flows decreased by about $1.7 billion, which could have been due to the fact that they launched Smartwater and Zyco Coconut Water, and it was not doing as well as they had hoped.
In the next few slides, I'll be talking about the financial statements for Pepsi. Some noticeable changes that we can see in the financial statements of Pepsi include changes in the net income adjustments, other operating activities, liabilities, investments, and effective exchange rate. Net income took a dip of about $1.5 billion from 2016 to 2017. And along with this, net income adjustments underwent an increase of about $2.5 billion from 2016 to 2017. Under the changes in operating activities on the cash flows, the other operating activities experienced a decrease of nearly $400 million. Another very noticeable change could be found in the liabilities. The liabilities decreased significantly from year to year, experiencing nearly a $1.5 billion decrease. The investments increased by a little over $2 billion from 2016 to 2017. Another very noticeable change that went in from year 2016 to 2017 took place with the effective exchange rate, which underwent an increase of about $300 million. Other changes include the increase in net revenue because of the favorable impact of the foreign exchange translation, and an increase in operating profit because market-to-market commodities were adjusted and reconstructing charges were increased. The other changes in the financial statements from year to year were not as significant. And this is the balance sheet for PepsiCo. And this is the cash flow for PepsiCo.
Looking at the current ratios for both Coca-Cola and Pepsi in the years 2016 and 2017, it is shown that for both companies, the ratio has increased throughout the year. In 2016, Coca-Cola's current ratio was greater than Pepsi's. However, in 2017, its ratio was less than Pepsi's. With the ratio increasing in both companies between the 2 years, this shows that there are not as many liabilities in the company as the year before, or they are covered by the assets that will be converted to cash. With Coca-Cola's ratio being greater in 2016, this shows that there are more assets within the company than Pepsi had, and vice versa for the year 2017. The quick ratio. In both years, 2016 and 2017, Coca-Cola's quick ratio was lower than Pepsi's, which shows that Pepsi had a better ability to pay their short-term obligations without the sale of inventories. The quick ratio for Coca-Cola decreased between the year 2016 and 2017, whereas for Pepsi it increased. This means that Coca-Cola's ability to pay off their short-term obligations is decreasing, whereas for Pepsi it is increasing. The inventory turnover for both Coca-Cola and Pepsi in the years 2016 and 2017 were far from the industry average. With an industry average of 7.34 in 2016, Coca-Cola had an inventory turnover of 5.9, while Pepsi had 10.37. In 2017, the industry average was 7.26, and Coca-Cola's turnover rate was 4.97, and Pepsi's was 10.15. Pepsi had a higher turnover rate than the industry rate both years, which is good because it means it was generating more sales, meaning more revenue than the industry was expecting. For Coca-Cola, this was the opposite case, since its inventory turnover was below the industry average.
For days sales outstanding, in both 2016 and 2017, Coca-Cola had a higher days sales outstanding ratio than Pepsi, which is not good because this means that it took longer for Coca-Cola to receive cash on their accounts receivables after making a sale. Fixed assets turnover. As you can see in both years, Coca-Cola had a higher fixed assets turnover ratio than Pepsi did, which means that Coca-Cola was using their fixed assets more efficiently than Pepsi was. From 2016 to 2017, Coca-Cola had an increase in this ratio, which is good because it means they are being more efficient, therefore causing more sales, whereas Pepsi's ratio decreased from year to year. For total assets turnover, in both years, Coca-Cola had a lower total asset turnover ratio than the industry average. This means that all the assets in Coca-Cola were not being as efficiently used as other companies in the industry. Pepsi, on the other hand, had higher ratios than the industry average, which shows that they were using their total assets much more efficiently than other companies in the industry.
Looking at the total debt to total capital ratio, in both years of 2016 and 2017, Pepsi had a higher debt to capital ratio than Coca-Cola, which means that a higher percentage of Pepsi's capital is provided by its debt holders than Coca-Cola has. In both companies, from 2016 to 2017, the ratio has increased, which means that more and more of the capital is being provided by debt holders. Looking at the times interest earned ratio, in 2016, Coca-Cola had a much higher times interest earned ratio than Pepsi, which means that Coca-Cola has a higher extent to where the operating income can decline before it's unable to meet the annual interest costs. In 2017, however, the two ratios were a bit closer together, but Coca-Cola's was a little less than Pepsi. This shows that both of these companies have around the same extent to which their operating incomes can decline. Looking at the operating margin ratio, for both years, Coca-Cola had a higher ratio than the industry average of 17.04% in 2016 and 17.89% in 2017. This shows that the operating costs of this company are in good standing. On the other hand, Pepsi had a lower operating margin ratio both years, just by a little bit, but this shows that Pepsi's operating costs were too high. Looking at the profit margin ratio, in 2016, Coca-Cola had a higher profit margin ratio than Pepsi, which means that its stockholders were making more than Pepsi stockholders. In 2017, however, the opposite occurred, changing it to that Pepsi stockholders were making more than Coca-Cola. In both companies, between the 2 years, the profit margin actually decreased, which shows that in both companies, the stockholders were making less for the year 2017. Looking at the return on total assets, for both years in Coca-Cola, its return on total assets ratio was lower than the industry averages of 7.95 and 4.36. This was not good because this means that it has a low return on assets than other companies in the industry. For Pepsi, however, its ratio both years was higher than the industry average, which shows that the company had a higher return on assets which benefits them. Looking at the return on common equity, in both years, Coca-Cola had a lower return on common equity ratio than the industry average of 32.32 in 2016 and 20.1 in 2017. This is bad because this means that the stockholders are not getting a high return on their money for this company as other companies in the industry, such as Pepsi, whose return on common equity ratios are higher than the industry averages. Looking at the return on invested capital ratio, for Coca-Cola and Pepsi, both years' ratios are lower than the industry averages of 21.46% and 12.4%. This is not good because the investors are not getting a high return for what they put into the company as others are in this industry. Looking at the basic earning power ratio, Coca-Cola had a lower basic earning power ratio both years relative to Pepsi, which shows that Pepsi's assets have a better ability to generate operating income than Coca-Cola does. looking at the price to earnings ratios, during both years, Coca-Cola had a higher price to earnings ratio than Pepsi, which shows that stockholders are willing to pay more for each dollar of profit. Since Coca-Cola had higher ratios, this shows that stockholders think it's a high-growth company and would be willing to pay more. Compared to the industry average in 2017, however, of 51.82, both ratios were much lower for both Coca-Cola and Pepsi. This shows that there are other companies in the industry that stockholders are willing to pay more for. Lastly, looking at the market-to-book ratios, the market-to-book ratio for Pepsi is greater than Coca-Cola for both years 2016 and 2017, which means that it is well regarded by investors because it has a low risk and high growth, whereas for Coca-Cola this is not the case.
In conclusion, PepsiCo and Coca-Cola have been major competitors in the beverage industry for over 100 years. Coca-Cola was the clear front-runner for the majority of these years, and it was not until 2005 that PepsiCo surpassed them. PepsiCo's success came from the different mergers, acquisitions, and partnerships that they pursued in the 1990s and 2000s, which broadened their product base to include more than just beverages. Based on our findings from comparing these two rival companies in the years 2016 and 2017, PepsiCo is overall the more successful company, and investors are shown to be more interested in PepsiCo than Coca-Cola because it offers low risk and high growth, which is different from Coca-Cola. By looking at ratios, you can see that Pepsi is a better company to invest in from a managerial perspective because it will allow the stockholders to get a higher return on their investment. Pepsi had a greater market book ratio, a higher basic earnings power ratio, debt to capital ratio, total asset ratio, and did seemingly better than Coca-Cola in many other areas.